Okay, peeps, welcome back. So today we're going to be talking about our markets overview for October 2023 and where are the markets going to be headed. This is going to be our macroeconomic videos. Just so you all know, this is kind of like the 10,000 foot view of what to expect in the markets. So anyways, let's get it. So the first chart you guys can see here that I have pulled up is the SPX. This is the S&P 500. So there's kind of a lot going on here, but basically we got the 50-day moving average in yellow, 100-day moving average in white, and the red 200. Or this is actually the weekly moving average, 200-week moving average in red. These are simple SMAs. These are not EMAs. They're a little bit different. So from this perspective, basically you guys can see that we got rejected off the 4,600 level. This was previous resistance. We just recently closed below this previous support zone here between 4,200 to 4,300. So that's kind of really not good, but we're still above this trend line. When we approach this trend line, we could see a bounce. Something else to note is we did see a MACD back here, MACD death cross in August on the S&P 500. And since that point, we have basically sold off pretty substantially. So from the peak to the bottom is about an 11% move down. That's considered to be correction territory, but we move back up. Now we're only down 9%. I say only 9%, but that's actually a lot for the markets. So if we zoom in here real close, you can see the 50 closed below the 100. The main thing that we're looking for here is whether the 200-week moving average is going to hold or not. This has been our bull bear indicator. If it's above it, then we're bullish. If it's below it, then we're bearish. You guys can see here on the October lows last year, we kind of had a fake out. So market tricked us once again. But it's currently sitting at 39.50. So why is this? Well, before we get into that, we actually have another trend line here, as you guys can see as well. From the pandemic lows, we're kind of tracing this thing up. So this could also hold too, which is at 4,000. That's just above the 200-week moving average, and we're about 200 points away or so from that. So why is the 200-week so important? Well, we're going to go over this once again. We're going to scroll back here all the way back. I'm going a little fast here, guys, because we got a lot to cover. So all the way back here, you guys can see that we had a death cross of all three EMAs. Okay, the 50 went below the 100 and then below the 200. That's considered to be a death cross. But when we saw a close below the 200 here, as you guys can see, we had a humongous drop on the markets. I mean, just massive. Look at this thing. So from that candle alone to the bottom, you're talking probably roughly about 46, 47%. So yeah, 48% all the way down to the lows. So it's kind of a big deal if this thing has a close above or below the 200-week moving average. You guys can see here, once we got below, we had a pretty big drop too. But again, this was the pandemic. That was kind of a black swan. So that's what we're looking at for the SPX. We're still technically bullish. Okay, so we're still bullish in the macro time frame. We are above this macro trend line. We are still sitting above the 200-week moving average. And we have not fully entered into the bear territory on either the MACD or the RSI, as you guys can see. So we're going to go over to the NASDAQ now. NASDAQ is still sitting pretty bullish. NASDAQ's actually painting a different picture than the S&P. We had a golden cross instead of a death cross on the NASDAQ here. So we basically want to see a pop back above this trend line, similar to the SPX. The 200-week is down here at 12,800. We did have a death cross, but we are still sitting above the 0 and the 50 on the NASDAQ. So NASDAQ is actually looking extremely bullish. Here's your support zones. Basically 10,000 to 10.8, 13.7 to 14.1, and your resistance is at 16,000 even to the previous all-time high. So the Russell 2000 is painting a different picture here. As you guys can see, we have had a close below the 200-week moving average and a pretty hard capitulation here. So if you guys are wondering about the OARC fund, well, it's kind of more or less small cap, micro cap stocks in that fund. So reason why it's tagged so much is part of the reason is because of the way the markets are performing. So we are about to have a crossing down of the 100 and the 200 week moving average. That's a triple death cross on the Russell, so that's not good. We have entered full bear territory here on both the MACD and the RSI. We had a death cross back in August. We did close below this macro trend line as well. The only real bullish indicator here is basically if we stay above the support zone between 1600 and 1700. The next support zone below that would be 970 to basically roughly around 1100. I don't think it's going to go that low, but we'll just have to wait and see. And then the high is sitting up here at 2400. So Dow Jones is still looking okay. It's better than the Russell, but not as good as the NASDAQ, I would say. We have had a crossing down or a death cross of the 50 and the 100, and a close below that, although we're still sitting above the 200. That's at 31,800. We're not fully into bear territory yet on the MACD and the RSI, so that's good. Our next support level here is between 29,400 and 31,300. And then your highs resistance sitting up here at roughly about 35.8 and 37, or just under 37,000. So that covers the indexes. Now we'll go into the 50-day moving averages. So this is actually what's known as a reverse indicator. So instead of buying at the bottom, how do I want to say this? So basically, when this is at the bottom is the most ideal time to be buying. And when this is at the top, this is the most ideal time to be selling or shorting. I call this a reverse indicator because this is basically a reversal chart. The indices may tell you this, but it's not going to tell you as accurately as the 50-day and the 200-day stocks above their moving averages. As you guys can see here, we had some major bounces over the last few years, and of course they ripped pretty hard to the upside after that. We went as low as a 10 on this one. We're currently sitting at roughly about 17 or so, which is pretty low considering the high is at 90 to 100. So it's a pretty good time to buy into NASDAQ stocks as far as this indicator is concerned. So the next one is the S&P one. So you guys can see here we had a huge bounce in March 2020, another big bounce in June 2022, and October 2022, which was the lows on the S&P 500. And we have another indication that says that it went low as a 6, which is pretty low. It's not like a 2 or basically a 2 like these ones down here, but pretty close. So according to this indicator, it's an excellent time to get in. Again, this thing can move from 10 all the way up to 80, 90, 100. So there's that. Now we'll take a look at the 200s. So this is more of like an investor. So the 50 is more of like swing trading and potentially investing, but this is more like long-term investors indicator here. So stocks above the 200-day moving average on the NASDAQ, you guys can see we had only just a few bounces over the years. So 2018, we had one, 2020, and then 2 in 2022, and we have not seen one since. And again, on the flip side, on the resistance, you guys can see that basically during the entire bull market here that we had in 2020, 2021, we were sitting up here for a long time. We had that drop in August of 2023. So according to the 50-day, it looks like we hit the bottom, but on the 200-day, we're kind of just sitting in the middle. Now, as far as the S&P is concerned, we are closer to the bottom. Again, as you guys can see, these are pretty rare dip buying opportunities here. Basically, when we get into this green zone, that's generally speaking the most ideal time to get into dividend-paying stocks. Okay, not necessarily swing trades, but dividend-paying stocks or whatever growth stocks or whatever you're into, okay, in terms of traditional markets. But for swing traders, basically, swing traders want to see the as swing traders, we don't necessarily use the 200, but we do use the 50. So when we have candle closes and price above the 50, which is the break-even level on the NASDAQ and the S&P for the 50-day moving average, when it's above that, that's basically risk on in terms of swing trades. So the next thing we're going to take a look at is the inverted yield curve. So as you guys can see here, we have the 2 and the 10. So basically the 10 is 4.88, the 2 is 5.06. So we're roughly about 18 percentage points away from uninverting. Again, we've told you guys that uninversion basically means that not immediately, but I would say maybe a few months after we see the uninversion, the markets usually tank. So we'll do, let's see here, US to Y / US 10Y. And as you guys can see here, so this is basically an overlay of the charts. We went as high as 124%. Basically what we're looking for is we're looking for a close below on the weekly below 100%. That would mean that we are uninverted with the yield curve. And then probably not immediately, but sometime shortly after, we may experience a large dump. I will leave a video in the description for you guys to look at where we talked about this. So you guys can see what we're talking about with a comparison between the inverted yield curve and the SPX. That'll kind of paint a picture for you guys as to what to expect. So Fed funds rate, we're still sitting at highs. Fed hasn't been hiking, but they haven't been cutting either. We are expecting them to cut soon. It's at 5.33%. And when we say cut soon, we mean like by the end of the year or maybe by the end of Q1 of next year. The inflation, as you guys can see here, core inflation is at 4.1%. We've come down quite a bit from 6.55. We'd like to see core inflation come back down to around 2.5%. That would be good because, as you guys can see here, that's kind of a resistance level. The headline inflation is at 3.7%. We had a small bounce, but we have come down roughly about 67% or so. And again, keep in mind, these inflation readings, they're not going to go up in a perfect line. They're not going to go down in a perfect line. So generally speaking, unless we see a golden cross, we're not really seeing another major move to the upside for inflation. We saw the death cross, and then that was basically it. We pretty much fell off after that. So unemployment rate, this is another big one that we've been talking about. We've seen a golden cross on this. That's not a good sign. That means that potentially the unemployment rate could go up. As you guys see back here, we had a golden cross back here, and this thing just basically, over the next 2 years, just absolutely ripped to the upside. And then when the death cross took place, then we kind of went down long term. But we're kind of hoping that this thing is just going to stay flat. It's not really going to go anywhere. But as the numbers come out, we will update you guys and we'll let you know what's going on. So now we're going to move down to oil. Oil is still looking somewhat bullish here. It looks like we might have another golden cross. Hopefully not. Basically, we saw a drop from the highs to the lows here. We're sitting on the EMAs. We're sitting on support. So basically what we're looking for here is, I would say, a break and close below 62 for prices to come down. That's what you want to see if you're a bull. If you're a bear, you basically want to see a bounce off 76 and go straight back up to 118. As far as we're concerned, we need to see a break below the trend line and the support zone and the EMAs to be truly bearish on this thing. So now we're going to go ahead and go over to the metals. Now, we're on the monthly time frame on the metals. You could do this on the weekly as well if you want to, but basically, in terms of whether prices on gold or any of these metals are expensive or cheap, currently gold is expensive. As you guys can see, we're literally sitting right at the highs on gold. It's at 1992. We ideally would want to buy roughly about 1470 down to 1380, and the next support zone would be 1200 down to roughly about 1050. Platinum's looking pretty cheap. If we were going to buy, we would definitely be buying at the support zone between 760 and 830. It's a little ways off that, so we don't want to buy yet, but the sell zone would be up here at 1750 to about 1900. Silver's kind of in nowhere land, no man's land. It's not really doing much. It's in between the support and resistance. Resistance is up at basically $30 to $37. Support's down at $14.30, all the way down to $8.50. Copper, that may be something that people are interested in, but copper is pretty expensive. The resistance is up here at $4 to roughly about 510, and the support's down here at $2 flat to about 125. Palladium, we have been sitting on this, basically this chart forever and ever, as you guys can see here, waiting for it to come back down to the support zone. So the sell zone's up here at 3,000 to 3,400. And the buy zones, our first buy zone is 1150 to 920, and then all the way down at $500 or 550 to 156. So it's pretty cheap, but we're not going to buy until it hits this green zone on the monthly. So that covers the metals. We're going to now go over the fear and greed index. As you guys can see, last month we were in extreme fear. This month we are currently still in fear. Once we switch over to neutral and greed, then it should be pretty clear at that point that the markets will go up. As you guys can see, a year ago we were at 64. So in terms of buying the dip for dividend investors, it's a great opportunity. In terms of swing trading, risk off. Swing traders are not going to want to do their trades right now based on this, unless there's like certain niche positions they're picking, or maybe they're position traders where they're just buying at support and waiting for it to rip. That's a little bit different. So now we're going to go over to the next chart, which is Bitcoin. So we'll start on the monthly chart and work our way down to the weekly. You guys can see we had a golden cross on the monthly. That's very, very bullish for Bitcoin because this is our largest time frame we look at. We also had a major bounce off of the SMAs here. Actually, let me get rid of these and move over to the EMAs. So yeah, give me just a second on these guys. I got to flip these over. So we got the 9 here and the 21. Okay, so now you guys can see it more clearly. We're about to have a major golden cross on the monthly. We have had a massive green candle. We have about 4 hours till close. So pretty good chance we're going to be above all of these candles here. So it's looking pretty good for Bitcoin, honestly. I mean, we bounced straight off this macro support level down here, and now we're hitting resistance. So if we go down to the weekly time frame, scroll in a little bit so you guys can see here, we did have a golden cross after a death cross right here, which indicates that Bitcoin's probably going to move higher. It's above the break-even levels on both indicators here. As you guys can see, that's very bullish. We bounced off the support zone. We had a golden cross right here. Might be a little difficult to see, but you guys looking real close here, you can see it's like right in this area, and we bounced. Now, getting above this $36,000 resistance level may be a bit difficult because you guys can see it's been resistance and support for a long time. It's a very heavily traded zone. But once it gets past that, we could be moving all the way up to 48,000 for Bitcoin. So Bitcoin's looking really bullish right now. Now we're going to go over to the, where is it? So the DXY is going to be the next thing. This is the US dollar index. We have some white trend lines drawn here. So basically, once we get breaks below those trend lines, that's considered, this is an inverse correlator or inverse indicators. So when the DXY goes up, stocks usually go down and vice versa. So for stocks to go up, we want to see this thing fall off a cliff, basically go back down below these trend lines in the support zone. But as of right now, the dollar is looking bullish. The MACD and the RSI are in bull territory. We did have multiple golden crosses here, and it's moving up. So yeah, this was kind of like some sketchy looking stuff right here, but it has gone up. We bounced off this macro support level, which, as you guys can see, has been resistance for a long time. So unfortunately, the markets are tanking while the dollar is going up. We want to see it close below these EMAs, then close below this trend line here at roughly about 101.26 and below the support zone at 100 even. So now we're going to switch over to the VIX. The VIX isn't really doing much of anything. We got our support zones down here and resistance up here. The most ideal time for dividend investors and long-term investors is to buy when the VIX is up here at this macro resistance level between 39 and 52 and 77 to 90. We have not seen that yet. Pretty much basically since 2021, 2022, we have not really seen hardly any of that at all. Last time we saw it was during the pandemic. You guys can see it's pretty clear on the chart, like where the most opportunistic buying opportunities are in terms of buying market crashes and dips. So that's the VIX. So we have two more things we're going to look at. We're going to take a look at crude oil, and we're going to take a look at the S&P. So the crude oil futures is still looking pretty bearish over the long term. As you guys can see here, we have they name them as prior settlements, but again, not really sure exactly what that means since these are prices looking forward into the future. But as you guys can see, we are expected to go down over the next year and over the following years, as a matter of fact, all the way through 2025. So we'll see. We'll have to wait and see how that reflects in the price on the charts. The other thing is the S&P 500. So apparently I was a little bit off in my estimates here. I thought that these settlement dates were set in stone, but apparently they're not. So the settlement for the end of the year, as of right now, is basically sitting just below 4,200, which if you guys can see on the SPX, we're pretty much almost exactly at that zone. So March of next year, 4,230, June, basically 4,300, September 4,322, and December just over 4,350. So it's pretty clear that these will change based on the price action. Whether we will see the markets go up or go down, that remains to be seen, but the general consensus here is that the markets are going to go up in the following years. So there is one more thing that I wanted to take a look at with you guys, and that is the FOMC meeting Fed Watch tool. So, as you guys know, or if you don't know, we'll let you know right now, the FOMC meeting is going to be tomorrow. Basically, that's where the chair of the Federal Reserve comes out and says, we're going to raise rates, we're going to cut rates, we're not going to raise or cut rates. That's important because that determines where the market goes, generally speaking. But as you guys can see, the current is between 525 to 550 in terms of percentage points. And it basically, markets are predicting that we're not going to move, that the Fed's just going to hold for this month, or I should say November. Again, hold in December, hold in January, hold in March, still a hold in May, and possibly our first cut in June of next year. We don't think that's going to happen. We think they're going to start cutting between December to March of next year, but that's just our opinion. We'll have to wait and see if things play out according to what we believe. So anyways, this is the markets overview for October. Hope you all enjoyed this content. Please like, comment, and subscribe. Let us know your thoughts down below. Peace.